Hello and welcome to March 1st blog for currency. Just two questions this week, both very good questions though. The first one comes from someone called Louis Ramirez, and what he says is, I've been having excellent results within the past year trading Forex by sizing my position rather small but then adding to it if price goes against me. The problem is at times I am up over 100% when I have a huge loss that brings me back to square one. Do you have any advice on how to profitably employ this strategy? Well, there's an obvious flaw in the strategy in that as long as markets tend to mean revert or don't really go through periods of trending, which is what happens probably 60 to 70% of the time, then the strategy of averaging in and keep on adding to your position means that eventually the price does revert back and you make some profits. However, that all breaks down as soon as market trends. Within the currency social indicators, it's very clear to me that we have a lot of traders who are doing these things. I know this because I can see the average price of longs might be at 145 when the current price is actually 142, which suggests to me that people are, once the position goes wrong, they're not employing risk management. There's two things that you can really do to try and get around this problem. The first one would be to actually go back through the first entry point and then work out that if that market or that trade went 40 or 50 pips against you, that you would liquidate the position and take the loss. So you would never do any averaging, and see where your profit was and see what happened there. So it could be that it proves to you that the strategy just doesn't stand up, and that normally if the market goes a certain amount against you, then it's going to take time for it to come back on side. That's personally what I employ. I've done a lot of testing over the years on what's called maximum adverse excursion, and what that is to say is every time I put an entry in, how far must it go against me before the law of probability starts kicking in and telling me that there's a very low percentage chance that I will ever turn this trade into a profit. This is extremely useful, and generally on foreign exchange, when you start following my trade, you'll see that it's very rare that I have a stop of more than 40 or 50 points, purely because I know that once it's got that far offside, there is a low probability that it's going to come back to me anytime soon. So that would be the first thing. The second thing would be to understand exactly where you're averaging in. You haven't said anything about whether you're increasing your volume each time you add, or whether you're just randomly adding a certain amount against you every time. One of the things that I really do, which is most important to me, is I analyse supports and resistances, and I use this by looking at points of the most time and changes in time and least amount of time, and this gives me very, very specific areas where I want to buy and sell. And because I've analysed that in terms of understanding where support and resistance is, once it goes 40 or 50 points against me, then it tells me that the trade is probably wrong anyway. The likelihood is I'm probably only going to be able to scratch the trade because it's going to go back to where I should have originally, where I originally put my position. So I think, having done the testing, I would say to you, think about, if you are going to continue, where you average in, and also your volume. There are there are occasions, let's say I have a resistance point at 20 and then I have one actually quite close, say at 70. Well, I can't really employ my stop because my stop is going to be where actually I might want to add to the position. And so what I would do there is I trade quite small on the first part of the trade, and if it is at that second part of the trade, I would normally at least double or even treble my volume at that point, and then employ a very tight stop on the whole thing. That way the market can come halfway back between my two entries, I can liquidate some of that position and then keep the original stop, and that way normally what's happened there is that I've reached the point where I can't actually lose either any money or very little money. So think about your volume as well. Try and think about extremes of range. For example, I use a study called range deviation pivots, which tells me the limit of range in a normalized trading day. That's very useful as well. You could use things like that as an averaging point. I'll probably do some work, do some videos on range deviation at some point in the future, so people can understand where I'm getting those calculations from.